now. S&P's right now up some 16 points. We're kind of slopping around a little bit. Uh, by the way, I did put on, we sent it out. I did put on the SPX put butterfly way out here. Okay. It's a 120 point move. I'm not sure we can get down there today, but we'll see. Jeff Bierman, come on down.
What do you Price is Right? Drew Carey?
Uh, no, Drew Carey will never be my Price is Right, ever.
Bob
Okay.
Barker?
Yes, you don't even, Drew Carey doesn't exist to me. So that never happened. I'm in complete denial. Actually, if you look at AI, they always have like, Bob Barker. Like there is no Drew Carey Price is Right. Has anybody here actually, and I'm being honest, has anybody here actually watched a single episode of Price is Right with Drew Carey? Is it even still on? Okay. Has
I
anybody
don't
here?
know. I don't watch it ever.
I'm asking the clientele of TheoTrade. I don't give a crap. Drew Carey. Okay. There's just no way. I grew up like, I think I learned how to like trade and count from Bob Barker. Okay. I'm dead serious with that. I would like wait for like those days that you had off as a kid. It's like 10 a.m. He grew up East Coast. Hmm. Nobody here wants to admit to having watched one episode. I have not. Okay. And I will stand true to that. I will absolutely not ever. Okay. Watch an episode. Price is Right with Drew Carey. It's never going to happen. Okay. Jeff, what do you got today?
Well, my coaching session's the last day of getting an edge on market leadership, but I'll give some commentary on the market today. I'm having a really good day, longs and shorts, both sides. There is opportunity out there. You got to search it.
I like that. Ever since I retired, sometimes. So, all right.
Gaussian, come on.
Uh,
Gaussian
yeah,
distribution. Okay.
yeah. I got it. Okay, it's actually a good name. It's a good name. I like the nickname there, Calcium Prime. It's a
Yeah.
good one. Jeff, yours. I gotta go work for a living today. I gotta go find some trades. The rotations are they're really pissing me off right now. I'm getting rotated against, okay, every day in a new way. XLP is starting to come around a little bit, but I have a couple of really crappy trades on Netflix, though, is actually starting to work today.
Yay.
So there's life in Netflix. Okay. I want to be happy getting out of these trades live right now. So not so happy. Okay. Not in denial just yet, but not far from it. Jeff, I'm going to turn it over to you. It is all yours, sir. Have at it.
Okay.
The next hour is Jeff Bierman.
All right. So let me say this and kick this off by saying good morning and welcome to the second hour of TheoTrade. I am Professor Jeffrey Bierman. I'm broadcasting live from Chicago, and it's 45 degrees today. It's like a winter, like summer breakout, 45 degrees. And today is Tuesday. It's February 10th. It's 2026. Good morning, TheoTrade members. Who's happy to be a Genesis Cog member today? How many winners we got? Literally every one of them's a winner, and the short is a winner too. Another one of those rare days when all the shorts and the longs work. There's opportunity out there, people. You have to find it, and I keep finding it, and I'm just playing it. But we're gonna finish up the final installment of Paradigm Shift, means to spotting leadership in markets. Because if you can spot leadership, you can get ahead of the curve. You can exit early, you can enter early, you can play strength, you can play weakness. It's a key. You have to understand, it's not a stock market. It's a market of stocks. It's a jigsaw puzzle. If you put the jigsaw puzzle together, you see the picture way better. But once the market leadership breaks down, that's pretty much the end of this bull market. But it's not there yet. Don't bury me. I'm not dead yet. That comes from the serpent and the rainbow. But we're going to cover for the next 25 minutes today's theme. So let me say good morning to the usual people. Hello, Miguel. Yeah, I know. Forget that one. The big winner for me is Lulu. I bought Lulu yesterday almost at 171. I'm up $11 on Lulu in 2 days. So that one I captured big time. Good morning, Rosario. Good morning, Bart F. Good morning, everybody. All right, as I say, kind of like Gene Wilder in Willy Wonka, the Chocolate Factory, reverse it. Remember how he says, so much time, so little to do. That's not me. It's so little, so much to do, and so little time. So if any of you can kind of put two and two together and figure where this cryptic theme comes from, I'll be very, very impressed. Anybody out there who is from my generation, and believe you me, I was born in 65, so this comes out a little after I was born, but I know because my parents used to listen to it. So today's theme is called Time in a Bottle. Yesterday, I profiled on the coaching session about looking at the Arun indicator, which is time by price, time over price versus price over time. It's a different way of looking at things. Today is time in a bottle. This market's time in a bottle. So let me go back and yeah, there we go. All right. RS Houski's nailed it. Mark 43, you got it, buddy. You got it. So let me bring this out for old time's sake. Everybody, sad but not to say, one of the greatest folk voices of our time. Maybe not yours. Music nowadays, not to offend people, sucks. Bad Bunny is garbage, all this. Music hasn't been good after 2000. There's only one good musician after 2001, and that is Bruno Mars. He's the only one who gets my respect. I'm an absolute music devotee. Best music ever written was the 60s and the 70s, followed by the 80s, 90s, and after that, it's just like turn your headset off. It's all auto-tune crap. But Jim Croce had a song he wrote that was called, and he wrote a lot of really good songs, and one that stands above all the others was Time in a Bottle. So Jim wrote the song in December 1970 after learning that his wife Ingrid was pregnant. So at the time, he was juggling 3 jobs and felt he could not devote enough time to his music or his family. So does that sound familiar, people? Because I'm going somewhere with this. Like everything I do has a sort of a cryptic connection to the market, even you wouldn't think so. People nowadays are suffering and they're spending less. They're making different decisions. Their jobs are hard to come by. A lot more therapy, a lot more Wegovy, a lot more people on Zoloft. The world is not in a place where it was 50 years ago. Clearly it's changed. But during Croce's time, his song Time in a Bottle gave personal context to the intimate and reflective quality of life, as it was inspired by the anticipation of a new addition to his family and his desire to make the most of the time he had. So according to Croce, this is what the song meant, Time in a Bottle. Time in a bottle reflects the desire to capture and preserve precious moments, emphasizing the fleeting nature of life and the importance of cherishing love and time with those we care about. So the song expresses a universal longing to control time, which you cannot, and make the best moments last forever. People, these are the best moments the market's going to see for a long time. Because once we start correcting, you're going to reflect back on this time and go, remember that day that Bierman talked about time in a bottle? Why didn't I take my money off the table? Because you're complacent, you're deluded, you're thinking that the algos are going to save you when they're not, because once this breaks, the algos are going to wreck the market like they wreck everything else. They're mercenaries, they're Machiavellian, they don't have a side. They don't have a bullish or bearish. There is no bullish or bearish algos. They just trade what's in front of them on slopes and angles. We just haven't hit the angle yet. But needless to say, Croce's lyrics convey the fantasy of saving time in a bottle to extend cherished experiences and protect them from the inevitable passage of life. It's a meditation of love, mortality, and the human desire to hold on to fleeting happiness, highlighting the tension between the brevity of life and the wish to savor every moment. There's a reason why I brought up this theme, time in a bottle. Obviously, there's somewhere where I'm going with this. So if you actually look at the pattern recognition of the market, look at it carefully. It's pretty amazing what you'll see, okay? I'm going to bring this out. Give me a time to draw the picture. Actually, let me go back farther. Let's go back way over here. Okay, this is like a ship. It's like a bottle. It's like a bottle, isn't it? Like a bottle. And there's times elapsing inside this bottle. But we're going nowhere. We're just repeating ourselves over and over again. And the interesting thing about this is, you know, ships have masts. It looks like there's a mast there. There's another mast there. It kind of looks like the Titanic, like they're just building ships and smokestacks and masts. We're inside of a market where we're just killing time, people. We're not going up, but we're not going down either. You and I know that if we could turn back the clock in our life, that we'd love to say, my God, I should have bought Meta at 88. I should have bought FedEx at 100. Damn that stupid NVIDIA. I should have bought it at 30. If you could go back in time, put time in a bottle, you would do certain things. What I'm telling you is that if you go look at past history and you see what market setups look like before they kind of roll over, this is what it looks like. So take this for what it is. Don't turn this into a time in a bottle cherished memory. Whatever you're doing, avoid this product. I'm telling you, like if I get out of this thing, go somewhere else, do what I'm doing. I'm buying everything that none of you own and they're all going up. Like I just had Lulu I bought, that's running higher. I loaded up on General Mills at 44. That's now at 48. I'm just buying stuff that you'll never buy because once this breaks and the memory's gone, you'll go, man, that guy said that he was buying all these stocks at 52-week lows. And that's what I'm trying to get to you. We're just killing time. Will we break out? Maybe. Will we break down? Logically, yeah. But when? This is not the type of setup. These are not the droids you're looking for. But let me give you a inside look today. I want to look at you hourly. Hourly. You can never fight the hourly MACD. You'll never make any money. You have no shot. The MACD right now is flat. What that simply means is this is a bullish move. It's bullish. It's bullish. It's a bullish move. But if the curvature of the slope of that MACD rolls over, we could easily go back to 67.85 and wipe this away. And your time in a bottle cherished memories becomes a friggin' nightmare. Whenever I'm up a lot, and I'm up a lot on stuff, I just get me the F out of that crap. I'm done. You're going to look at this, and if this flattens out and rolls back down, because we're making lower highs and lower lows on the RSI and on the MACD, these are bearish divergences. You'll look back on this time when we eventually go through 66.30. It might be February, it might be March, it might be April. I don't know. I don't care. I don't waste my time trading this product. The risk reward is so bad that if you're wrong, it's going to blow your account up. So find something else to trade, but certainly not this is my cherished advice to you. Hail to Jim Croce and time in a bottle that served its purpose today. Remember what this looks like because it ain't going to look like this forever. As far as macro stories are concerned, I got 3 of them. I always got a lot, but what the heck? I'll bring up 3 today. Temper, like temper your, enthusiasm, temper your expectations. Now, this isn't necessarily bearish or bullish, but it's very important you pay attention to this. U.S. retail sales unexpectedly, everybody thinks they're going to rise forever. They don't. They're cyclical. They unexpectedly stalled to close the holiday season. So the holiday season wasn't that great. But here's the thing. What were consumers buying? Where were they making their moves? Here's the answer. We're in a K economy. It's a 1090, where 10% of the economy is controlled by, the 90% of the economy move is controlled by 10%. The other 90% are like living in a bunker, saving and not spending at all. They're doubling up. They're not buying houses. They're living with relatives. They're living with their parents. Okay, they're cutting back on expenses. They're not paying healthcare, not paying car insurance. Okay, think about what people are spending on. They're not spending on things. They're cutting back their spending on beverages. They're cutting their spending back on a lot of food, certain types of foods. They're making adjustments to their lifestyles. So it's not that every single retail stock's going to fall out of the sky. It's that the ones that are driven by the wealth effect and the wealthy will be unimpeded by this. That's why I bought Lulu. Lulu isn't affected because people who who work at McDonald's don't buy Lulu. It's people who are lawyers and doctors and traders buy Lulu. So they're unaffected. And the retail sales themselves, it's going to be a minefield. So my advice to you is make sure you pick and choose very carefully which retail stocks you own. I'd rather own Gap, okay, if I were at the lower end, than own like Macy's. I'd rather not own Kohl's and own something else. You've got to be careful what you own in the retail sector. But the retail sector is in the XRT, which we'll cover during the discussion today. I'll bring up the XRT. It's stalled. Does that mean it's going to crash? Never said that. I never said that. I'm just saying to you, it's in a stalled mood. And if it tips and rolls over, it could drag the other market leaders down with it. So be careful on that one. The next one I bring up is Peking Duck. Again, I just can't help myself. There's an embedded pun in this. And I don't think a lot of you are going to get the embedded pun. I think I went right over your heads. You have to read the headline to appreciate the embedded pun. China is playing the sell America game. And it's going through the Olympics too. It's all across the world. There's a sell America, anti-America kind of like rhetoric out there and feeling. Okay. China is urging banks to curb exposure to US Treasury. Okay. They're not just urging Chinese banks to sell US Treasuries. They're encouraging everybody around us to sell US Treasuries. Canada, Europe, Australia, South America. Cut your exposure to US Treasuries for two reasons. One, they're pissed off at us. But the other reason is because they see inflation not coming down. They don't see value in owning treasuries. They see problems with interest rates moving higher because they're watching the Japan 30-year yield, which is pushing higher. I would advise you, and I call it Peking duck because duck is not, I'm not using it in the form of a noun, like a canard, like an animal with web feet. It's Peking duck because they're telling us to duck the US. That's where the pun comes from. I keep telling all of you, the reason why the market sits afloat here is because the US Treasuries, they're not going up. Everybody knows they're not. Oh, they pushed higher. So what? It's a bear market. The only way this can push higher is not if the Fed cuts rates, because if the Fed cuts rates, it has no impact. That impacts the overnight lending rate. It's not impacting this because the Fed's cut rates already 4 times, and this keeps going into the toilet. So clearly there's a disconnect between your brain and this. This is not affected by the Fed. It used to be, it's not. This is a completely different animal. That affects banks, but not consumer. This is consumer credit and treasuries. What I'm telling you is this, that if China keeps urging the rest of the world to sell US Treasuries, how is this product going to go up? It's going to siphon liquidity out of the market on this, drive treasuries lower, and drive yields higher. If it drives yields higher and we get through that 5 handle eventually, how is that good for stocks? It's not. Because if it goes, it's holding right there. If it goes through the 5 handle, automatically you're going to say, well, why would I buy a US stock to make, 2% or 2.5% yield when I could buy a treasury for a 5% yield with half the risk? You won't. There'll be a tactical allocation shift and everybody's like, well, hell with it. There's no reason for me to own stocks. The reason why stocks are going up is because they don't want to buy bonds. There's been no tactical shift to bonds. If there is a tactical shift to bonds, that will drive equities down to buy those bonds. But what if interest rates do go higher and they don't shift to buying more bonds? Well, they're going to have to shift out of equities and find another place. And that money's going to go to gold and silver. So beware of the fact is you're not getting any traction in the bond market to drive the stock market higher. The stock market's going to have to go up on its own through its own liquidity sources. And where that's going to come from is anybody's guess, because it certainly isn't going to come from bonds at this point. The next is this. And Don stole my thunder, which really just crosses my chap. God, I'm having a really good day on the market. I mean, a really, really, really good day. I'm up 2% today on a flat market. And I got 6 shorts and I've got 8 longs. That's how you do it, okay? You have to pick your spots really carefully. And if you waste your time with that S&P, okay, you're always playing, it's hard to win, okay? Yo gamma gamma. So Kaufman comes up earlier and talks about gamma. So this is where I'm going with this, because this is a play on the term yo gabba gabba, like my kid used to watch it when she was a baby. So Goldman has a bunch of macro traders, but the most seasoned one came out last night on Zero Hedge and said, look, he's warning that the rate of change is accelerating. So the terminology inside of options market, that nomenclature is gamma. Gamma, by definition, means rate of change. What does that mean? It's like you drive your car, you press your foot on the gas pedal, and you see the accelerator go up and down. That's what rate of change is. Rate of change is not about direction. That's the mistake people make. It's not about direction. Trend is direction. Trend up, trend down, trend sideways. Rate of change is the magnitude and the speed of movement in a short duration. That's the difference. Trend is about, stretched out, protracted duration. That's not what gamma is. Gamma is not about protracted duration. It's about right here, right now. What this means is, Goldman Macro Trader is telling you, that the swings inside this time in a bottle are becoming more pronounced, more extreme. The rate of change of move to the up and down side is accelerating. You're not getting, 10-point walk-ups. You had a 150-point walk-up on Friday, 150 point out of the mark, out of the, run up, 150 points on Friday. You had 132 points on Wednesday. You see the moves? The acceleration factors of moves up and down are going faster and faster and faster. So the reason why I bring this up, okay, is not to scare the children. It's what I see happening. The next leg down that we take out, the next leg down that we take out on this, on the lower end of this, okay, if we take out that 6650 over here, there it is, 6600, you're not recovering. That's what I'm trying to tell you. This is my point. When it breaks, when is it going to break? I have no idea. But when it does break, what the macro Goldman trader's telling is, none of you permabulls, Corey, you're not getting out because the fall will be too fast. The rate of change or the gamma of the swing down will be much more pronounced, much deeper, and much faster. And the algorithms don't buy into dips. They sell into 45-degree angles. So the next time we break 6,600, it won't be, oh, we're down 100. We're likely to fall 300 to 500 within a day or two. That's what I'm telling you. The rate of change of movements of up and down day to day, you can call it, it's not the ATR, but the rate of change of movements, because that's a range movement. The rate of change of movements are faster and more furious and more unforgiving. You've been warned. Okay, let's get to the individual stories of the day, of which there's a happy place, people. Happy place. First one, game on. All right. I'm out of this stock. I owned it. I made my 20 bucks, so I'm not complaining. I'm out. I don't hold through earnings. Game on, because On Semiconductor delivered good, not great, not great. That's not true. But it's gone. It's up. There it goes. It's gone. Okay. Here's a stock I actually bought down here and sold up there. I bought it here and sold. Why would you buy it? Because it's friggin' cheap and it's a breakout and the risk is almost zero. I made this is easy money. I'm just like no risk. Look at that. I'm out. Been out since there. Haven't been back since because it's not fitting what I needed to look for to fit my imprint. But I like this stock. Most semiconductor stocks are wildly priced and got bashed like Qualcomm. The reason why this stock is walked up is because the stock's growing at about 25% year on year. The PE ratio is about 25 to 30, but because it's growing at the same, it's not 233, it's totally off on the platform. But because the stock's growing at about a 30% clip and the PE is about 25 to 30, it goes hand in hand with its valuation metric. So if you ever said, this is a bubble, that's not a bubble. Walmart's a bubble, Costco's a bubble, Coke's a bubble. That's not a bubble. That's not, because it's growing consistent with its valuation metric. Would I buy this? No, I don't buy it high. It's too much risk. But when the market corrects, and if this corrects down to 45, my advice to you is put this on your watch list, because this is on the Bierman Genesis Cog watch list. Load the boat at 45. At 45 bucks, I'm mortgaging the farm to buy the hell out of this. This stock never misses an earnings estimate. It's an under the radar semiconductor. You follow Gianni's, Micron, and you follow Qualcomm. It's all good. To me, this is the crowning jewel of a stock you can buy that won't wipe your account out because the valuation is not completely disconnected. I'm bullish on it, but I'm not going to buy it at the high. I like what I hear. Game on, because the name of the company is On Semiconductor. There's a pun there. Okay, let's move on forward. Another one from the word spot on. Okay, I don't trade this. I wouldn't trade this if I were the last man on earth. I would never trade this stock. I don't at any price. But Gianni will trade this from time to time. And this is all I'm going to bring this up to you. There's two things you learn about this. Number one is this. Never trade into an earnings. Let the earnings report and then trade. This morning, Coke reported, they traded, it bounced, I shorted into it, and now we're killing it. I started shorting Coca-Cola around that 77.5 level, and now I'm up $1.25. That's how it's done, people. That's how you do it. You wait. The bounce comes, and then you can sell into it, okay? This is a situation where I'm going to quote Corey and I'm going to quote Tony Rago. You got to listen to these guys. They're really savvy. You cannot short into a hole. I don't even care what you think. I shorted into PayPal. Don't do this. I don't care if you made $8. If you're wrong, you're going to blow your account out. Don't do it. This is proof positive. Shorting into a hole doesn't work. They reported earnings that were 527, which are $2 above. Now, why this stock imploded when the earnings were, sequentially better is anybody's guess. Maybe it's just an algorithmic trade. Maybe it's just somebody crapping the bed, but their earnings went from $1.82 to 527. Does that seem like a company that's going out of business? No. Like there's a lot of companies that are garbage out there. Garbage. Roblox is garbage. It's garbage. It's crap. It's dog poop. This is a quality company because they're putting up monster numbers. That's serious money, people. It's up $68. All you had to do was see how it's oversold. Don't even take a position. Don't. Just go, humana. I'll buy a straddle. By buying a straddle, all you're saying was, and the straddle was about $35, you would have made $3,500 on the straddle. More, you would have made $3,200, $3,800. People, you can't short into a hole ever. That's number one. Because if there's a short squeeze, a buyout, a reversal, whatever, okay, you're out, you're done. You're not a TheoTrade customer. They'll wipe you clean. I don't know where that's going, but this stock had already priced in an earnings myth. The reason why it went from 785 to 400 was probably because it was a little bit expensive. It was expensive. But at the same time, once they get it down there, the news is already priced in. Unless the company reports a $5 miss, it's not going to go down. It's going to sit there and trade flat or bounce one way or another because all the shorts, it's like, it's a compressed like slinky where they're going to bounce it. This is proof positive that just buying a call or just even not even picking a direction, buying the straddle when the stock is deeply oversold and has a high expected move, that's the game. That's the game you play. This was an opportunity of a lifetime for a lot of you who probably lost money to capture that money back on a straddle. That's what you learn. If you shorted into us, I just fire. You're fired. Why the hell would, it's already down 300. What's wrong with you? Come on now. They already priced whatever misses into it. Next on here is what I call decarbonated. So the Genesis cog hunts and pecks for trades. We have a scanner, which is technically driven. And then we got me. And I go out and I hunt and peck for hours at a day, looking for one or two, I'm going to quote Kaufman, needles in a stack of needles. I'm looking for a 4-leaf clover of trades. So I find short, I find long. Like just yesterday, I went out and shorted Fastenal at near 48. Now look at it, it's down $1.50. Again, I'm very careful. I have a model. I follow the model to a T. I integrate fundamentals, which the scanner doesn't do. And I put this, and I told every Genesis Cog member, don't short this stock, period, until the day they report. Once they report, let's hear the news. Let's see what happens, because they could take it higher. If they open it lower and it bounces, I'm going to go out and I'm going to put an alert. Alert went out early this morning, way early this morning, way early, 8:45 a.m. It was done. My guy Arson's got it out there. I said, short this at 77 and higher. Just go for it. Okay? Decarbonated. Now, people, let me explain to you why this is a short and everything that you short doesn't work. I'm going to explain this to you. You have to pay attention to the narrative. The narrative is everything. Coca-Cola, they beat. Okay? Nobody cares. Nobody cares. They beat by, they beat on, and their earnings went up a penny. So their earnings growth is 1%. Then why the hell would this stock trade at a 25 multiple? That's a bubble. Okay, I'm teaching you something here, so pay attention. This is an easy short. Can't go any higher because the stock's way too pricey, way too pricey. They beat by 2 pennies. Earnings are still only about 5%. Then why are you trading at a growth rate of 25%? Why? It broke the algo channel. It broke. There's the Bierman algo channel. Once it breaks the channel, it's open. It's Wabbits, Doug hunting season. That's the easiest short you'll ever get. Right there. There it is. It broke. So now the algos, the slope has changed and it's pointing down. You can't short what goes up. You can't buy what goes down. That's the Genesis Cog way. Join the club, catch with the members, ask all of them how they're making money here, people. Don't short on the way up. Just short on the way down. You're good to go. The algos will defend you. That's why I picked this. But I picked it for one major reason. The company's revenues stunk. Their revenues were way off. They missed the revenues by 3.5%, which is like a landslide for Coke. Translation, the consumer is not paying up for Coke products because they're too pricey. I go into Jewel Osco every weekend with Target. Pepsi is about 30 to 40% cheaper. Pepsi falls off the shelf. Coke just sits on the shelf. I was on top of this the whole way, people. I kicked the tires, did the Peter Lynch. That stock is a bubble. I'm short, okay? I'm riding that heavy, baby. Good night. Next one on here. Alpha Dog. So, Datadog is a phenomenal company. I do not trade ahead of earnings, but I got to tell you, it's up 17 bucks. That doesn't surprise me. The stock went from 200 down to 100. Cut in half. Yay! That's opportunistic buying. But the Genesis Cog never plays with fate. We never trade ahead of earnings. If we're in a position ahead of earnings, we either buy the put if we're long, we buy the call if we're short, or we just exit the whole trade and we stand on the sideline and watch it. We let the suckers try to figure this out, because you can never figure out what the hell the market's thinking any given day of the week. You got to wait. Got to see the reaction. Here's a 16-point bump. Would I buy this? Not necessarily, but I love the earnings. The earnings are absolutely fantastic. The company still trades at about a 60 multiple, which is still too pricey for me to buy. But my point being here, this is like point number 2. Again, you can't short into a hole. This stock was already priced to miss. The reason why the stock goes down 100 points is, number one, people think it's really expensive and they think that the expectations are too high. But once you deliver better than expected expectations of lowered expectations, the stock's going to go up. The reason why stocks get killed is because the expectations are too high and they deliver and people are like, yeah, that was good, but that's not good enough. And then they beat the crap out of it. That's what Coke is. This is the polar opposite of Coca-Cola. Learn how to trade around earnings. Don't pick sides. Either buy the straddle, because you could have made money on the straddle. Don't pick a direction. Or wait on the sidelines like I did. See how they react and then act on it. That's exactly what we did with Coca-Cola. There you have it. There's your lessons of the day. There's your coaching session. Now, let's finish up the final installment of market strength. We're going to bring it all together. I'm not going to bring up every single indicator, period, but I am going to bring up all 5 of these, because these are the main drivers of the S&P. Now, the S&P has 11 categories. State Street is the one who is the sponsor, the vendor, call it what you want, who is responsible for the namesake nephews, like Invesco Field, Levi Stadium for the Super Bowl. That's in San Jose. There's always a sponsor who pays millions of dollars to have their name up there because it's like an advertising board. So State Street controls this. There are other ones that have their own compilation, but they can't necessarily call it State Street. The K is the technology, the F is the financials, the I is the industrials, the V is the healthcare, and the T is the XRT is the retail. RT means retail. So these are the 5 by market cap largest ETFs that mimic the sectors in the S&P. But they're also what I call like blanket statements for leadership. So if you can track all 5 of these all the time, oh hell, you can just turn off CNBC and Bloomberg forever. You never need to watch those channels. It's a waste. News is a waste of your time. Watch price behavior. Like Tony Rago says, price behavior is the ultimate judge, jury, and executioner. That's all you need to do. That's Gianni says it, Corey. Just watch the price. Just watch how these move, and you'll see how behavior manifests itself in a sort of like a puzzle format. And then you can put the pieces of the puzzle together to see how leadership is either holding up the market or weighing it down. Comparative analysis I covered. I don't want to go through all this. I just want to show you, okay, in a comparison chart type of way, okay, how you can look at leadership like in a sort of a glacial way. Instead of looking at things in pieces, because I always say it's not just a stock market, it's a market of stocks. But if you were to overlay all of these ETFs, which are sector representations, leadership representations, how would it help you spot changes in leadership to get you ahead of that curve so you can short, you can avoid risk of ruin, you can buy puts, you could short futures? How would you do it? Okay, this is something that a lot of you don't do. The only person I know, to my knowledge, that does this at Theo is Brandon Chapman. What Brandon does is he builds a table on the watch list. He has a watch list in the upper left-hand corner where he lists all 11 ETFs. They're lined up so you can track them. What he has next to each one of them, and I'll show you what Brandon does, is he comes over here, right up here, and he has a watch list. And he gets rid of the news and stuff, which I should just get rid of this, but I have this up for one reason. I just track the VIX. Not that I think it doesn't drive my thinking. I'm just looking for that to hit 80 so I can take a snapshot and show people. I told you it was coming sometime, but that's probably a long ways off. But Brandon's got a list like this where he'll put over here, instead of saying low, high, that's not what Brandon does. Brandon puts up on the watch list. He does it. He clicks on this and he says customize, and it pops up here. Instead of putting low, high, Brandon puts up percentage change. Percentage change. He'll go down here and he'll say, I want percentage change. And he'll put up percentage change right there. You see, it's the first one right up there. It's percentage change, and he might do percentage change since, and he'll select a duration of time so you can see how much it's changed percentage over, percentage gains or losses over time. That's what Brandon does. That's not my optic style, but it serves its purpose. What Brandon does is he creates the optic through numerical text. What I suggest is something a little bit off the beaten path. So this is what I suggest if you want to track market strength. Now, I talked about relative strength, which is comparing one index or product to another index or product, or or any combination you want to. It doesn't compare the strength of itself against itself. It compares its performance over the duration to something else, and then it builds an index and shows you whether it's outperforming or underperforming. If you want to learn more about that, you're going to have to go into the archive. I got a personal archive. There's 11 categories. You go into market strength. That's the title. Click on it. It's done chronologically, and you'll see there's parts 1, 2, 3. Go to part 2, and you'll see how the relative strength indicator, not relative strength index, but relative strength indicator comes into play to help you get an edge optically so you can figure out how to trade the markets. This is what I want you to do today. It's a little different, so bear with me. I mentioned to you, like, let's talk about the XRT today, okay? Because I started getting short a little bit. I'm long Lulu. He's long Lulu. What a moron. All right, I'm up what? $9 today? Okay, I'm a moron. And of course I'm short other things. Like I'm short shares of Monster. I'm short shares of Coke. I pick and choose my spots, people. So this is the XRT. Now, again, you have to step back and understand where this comes from. It says Spider, SPY. So it's Spider S&P 500 retail ETF. So if you want to know what makes up these components, you pretty much have to go to an outside source, type in XRT components, and you can do that anytime on your free time, XRT components, and it will bring up the XRT components. It will, like I can bring up stock analysis. You can do anything you want. Here are the XRT components, and you're like, there's CWH, PSMA. It tells you what's in it, okay, by percentage weight, right? So I'm just kind of throwing that out there. But this is what I want to drive home, okay? What you ought to do if you really want, if you're an S&P 500 trader and or you are an ETF trader, State Street Spiders, or both. This is how you can efficiently command and master trading. This is how you do it. Convert this to a line, just a simple line. Keep it really simple. So I go, okay, style, chart type, line. So now you see it's a green line. This is your XRT sitting near a 52-week high with the market, yada, yada, yada. Okay, now watch. Come in here, and I'm using the 1 year, and then pick a comparison chart and say, okay, how is the XRT comparing in performance to, let's say, the XLI? Now, what people say, well, what's the XLI? The XLI is the State Street Industrials, Caterpillar, Deere, Sherwin-Williams Paints, Pittsburgh Paints, Illinois Tool Works, Black & Decker, Okay, you can go through it. Stanley Black and Decker. They have, 30, 40, 50, 60 that make up the basket. But what do they all have in common? They're cyclical stocks that are the heartbeat of America that have to do with manufacturing. Earth movers, tools, fabrications, metals, what have you. Okay, this is the industrials. Add the industrials, hit enter on your keyboard. Now you see the color is blue. It's a blue. It's a default color that differentiates away from the green, which represents the XRT. So now what you've got here is you've got a comparison chart between the XLI and the XRT. You can clearly see that. Okay. Now, turn the style. And if you don't have this, you need to convert it to what's called show prices percentage. So if you hit show prices percentage, it will flip this y-axis from a price to a percentage. You need to contextualize. And it's important you contextualize because the price of the XRT is vastly different than the price of the XLI. The price of the XRT is $88.71. The price of the XRT is $171.54. Huge differential. So by converting it from a number to a percentage, you can make comparing apples to apples instead of apples to oranges. You're contextualizing by converting it because you're percentagizing it, which puts into a different kind of like valuation paradigm. You can clearly see, okay, what's been leading the market higher. What? Look at it, okay? You realize the market's being driven by the XLI and by the XRT. You can see it. The XLI is in blue. That's the industrials. The XRT is the green, which is the retail, those two sectors. So if you're asking, where does market leadership come from? Come on now, wake up. Right there, you're seeing market leadership come from retail and industrials. Okay? Now, here's something else to throw at you. Go ahead and just throw down the comparison just on the S&P. Just leave up the S&P. Double check the S&P to make sure the S&P is a different color. So I'll change it to something like over here, orange color. Click on it, hit enter, click apply. So there's your S&P. So in the last year, the S&P is up about what, 14.88%? But that's not the important thing. The important thing here is not the y-axis number. That's not irrelevant, but it's academic. You're missing the point. The point is, when you start to overlay these and see where leadership's coming from, and you cut down the time frame, look what you start to see. You're starting to see, well, what's making the market go? What's making it go? Okay, there is your, right over here is your yellow, your comparison, and that is, quote unquote, the S&P, and that's over the last 3 months. That's retail over the last 3 months. And that's the industrials over the last 3 months. So if you're saying, well, where does leadership come from? Why would you even ask that? Can you see it? It's right in front of you. The S&P is underperforming these. So you realize the puppet master that's holding the market up. What's holding it up? Garrett's like, it's just liquidity. It's not just liquidity. It's liquidity that's siphoning itself into certain sectors. Certain sectors are lifting it. Certain sectors are repressing it. If you want to know what the market's holding up is, it's these two sectors. So what can you draw from? What conclusion can you draw? It's this. If retail and industrials give way and start blowing up, you know the market's, what's the S&P is going to do what? That. As long as these two, like pillars, hold together, that's going to hold its water right there. You can literally see in one equilibrium diagram stylized picture how the market operates. You don't need to look through 500 stocks like me. I'm an idiot savant. I look through all 500 like I'm lawnmower man, like Jeff Fahey. This is the easiest way to do it. Literally, you can have no experience in the business and go, damn, there's the S&P, there's above. Oh, those ones are carrying the market. Yup. So if those keep going higher, what's the S&P going to do? It's going to stay elevated. See that? Now watch. This is how you can track market leadership. It's the easiest way to spot it. Let's go to something else. Bring up another comparison chart. Okay. But this time, We're going to go with the XLK. The XLK. What's the XLK? Technology. It's the State Street technology, which makes up 1/3 or more than 1/3 of the entire market cap. We'll change this one to this like color in the corner right there. Now we'll hit the enter button to lock it in. Click OK, click apply. Okay. Don't worry about over here. The axis doesn't mean anything because you can't, they're all disparate prices. The only price you can track is the XRT, which is the green one. You can't track the others. Now, watch carefully. You got technology below the S&P. So ask yourself, what is restraining this market from going to 8,000, 7,500? That's it. But it's bounced. Doesn't matter. Doesn't matter. As long as it's not above it, it's underperforming. And if it's underperforming, what do managers tend to do? They tend to lighten. Managers tend to buy into strength and sell into weakness. So are they going to buy tech? Maybe. But at this point, they're piling in retail, they're piling in industrial, they're holding their water here, and they're looking at this going, yeah, we still have a weighting in technology, but we're not funneling money in here. These two, by percentage weighting, are not enough to hold up the S&P. The retail makes up, and I'll tell you what the retail weighting is. Retail sector weighting, SPX. It'll tell you the retail sector weighting in the SPX by component. It'll tell you there's weights, and I'll just bring it up here. I need sector, S&P sectors by weighting. Oh, it's not even, I'm doing a copilot, and it's not even giving it to me. Okay. Well, somewhere in retail, it's far less than it should than technology. The industrials make up about 9 to 10%. Retail makes up about 12 to 13% according to this. That's a far cry from that. So if you put these two sectors together, it doesn't even make up that one sector. It barely makes up even half of it, up to a little more than half. So you realize that's the one that's carrying the sucker, right? What's carrying the market? That. Because if that blows, that won't even matter. These are hanging on by a thread. Now, take a step forward. Add another comparison one. And you could leave this up all the time and save it so you don't have to like recreate this each time. How do I save it? I'll show you. Go to studies and save it. This is the XLV. What's the XLV? State Street, another spider, SPDR, ETF, sector, healthcare. Healthcare, Select, Merck, Humana, Cardinal Health, Lilly. It's got everything, people. Intuitive Surgical, Medtronic, Stryker. Got everything. Look, add that sucker. Change the color. What am I going to do? I'm going to use this color in the corner. Boom. Hit apply. See what's going on here, people? So when people say, why is the market holding up? Because the breadth has broadened. You have leadership in retail, okay, which is the green. You have leadership in the sort of the muted peach, which is healthcare, and you have leadership in industrials. And of the three of them, it's the industrials that keep driving this sector and keep it elevated all the time. Not technology, people, not technology. So you realize adding these three together start to make up one of these. Those four are the top four of the top five. What you need to do now is, oh my God, I'm just freaking out. I'm sorry. I'm making money way too fast and it's making me really nervous. It's like I want to do something. My Coke's getting more blown out and my Monster's rallying. It's all coming together, people. Okay, last one. Add, just for kicks, comparison. And now you step in and you add the XLF, which is the State Street financials. Look, financial select sector. JP Morgan, Citigroup, AIG, MetLife, Hartford Group, okay, Hood, every trade, broker dealers, banks, regional banks, international banks, insurers, fintech, Lemonade, whatever, SoFi, it's all there. It's in there. Okay. Change the color. You got to make a color that stands out. So this color, I'll pick in the corner down here. Hit enter, enter on the keyboard, click OK. Now you see the whole picture at hand. This is the whole picture. This is what you need to see. This is the thing. This is why you pay to come to Theo. Why is he bearish on the market? Because the two sectors that can carry the market higher, that collectively, the financials, that's your XLF people. I'll bring it right to you. Clear the drawing set. Bring out a drawing. I'll do an identification for you. That's the XLK. Right there. That one is the XLF. Got it? This one a little higher, that's the SPX. Okay, and these collectively, there's a little bit of the XRT here, XRT there. You got up here the XLI. See where I'm going with this? And over here, you got the XLV, which is the healthcare. Now understand what you're seeing. Take this picture, take a snapshot of this, because this tells the whole market story. You can spend 8 hours or spend 10 seconds of looking at this and figure out what's going on. Why is the market not going down? Because these three sectors are holding the market up on a string. See? These sectors are in line or underperforming. So they're correlated with the S&P. If the S&P drops, they're likely to go with it. They're going to go with it. These are the ones that are, fight against the light. It's like that the charge of the light brigade, rage against the light, rage against the light. This is the one raging against the selling pressure. These three sectors are holding the market up on a string, not like a strong chain, a thread. So when the market rolls, we're going to blow, because these will be the last to fall. Those will be the first to fall. So if you actually want to know what leadership is happening, where's the leadership? There's your leadership. That's holding up the market. They're the three largest market cap sectors in the S&P outside of the XLF and XLK. These two make up about 70, close to 70, a little bit underneath. These three barely make up about what? Oh, about 25, 28%. Okay, let's say this is about 65%. That's about 25, 20%. The rest is just fodder. It's, IYR, energy. They can't carry the market. Neither will materials. This is crucial you understand this. Because if you see this start to converge and break, and this doesn't move up, you're dead. This is going to go, whoa, they're all going to go together because they're correlated. They're correlated. You can't break those correlations entirely all the time. There is going to be something where it's like, what's wrong with this economy? I don't know, but if it's going down, I got to sell. The psychology of money managers is simply this. They are not going to sell unless you give them a reason to sell. But by the time the market breaks down to 63, 6,200, 800 points, you will find that reason why you should have sold, and it'll be too late. What this does is it gets you ahead of the curve. It screens out the noise, all that white noise and that crap from TV and Barstool Dave social media. It screens it out and says, watch these 5 sectors. These are the leaders. These are the ones that are just defending the market. And if they no longer defend, what am I going to do? Okay, you have a lot to do. You can short the S&P. You can buy puts on these ETFs. You could short these ETFs. Could I short the XLI? I don't see why not. If you see the XLI breaking down, okay, easy to borrow. Go ahead and short it. What are you afraid of? Put your money where your mouth is. Why wouldn't you mix and match? What does that even mean? It means this. I own the S&P and I'm frightened and I can't sell it because I got a tax burden. Then don't sell the S&P. Short the weakest sectors inside this. I erase these, pardon me. Just short the weakest sectors inside of this and ride the S&P down. The S&P's dropping. It's okay. It's okay. Calm down. If you're short the XLF and the XLK, you're going to lose money, but you're going to lose a fraction of the money because your hedge will shock absorb your losses. You never want the hedge to be 1-to-1. Ever. Ask Kaufman. If the hedge is a greater source of risk than the underlying, you're screwed, you're beeped, you're done. The hedge should never be, well, I'm going to short 100% hedge. You can't make any money. You won't, because all the gains you make on the short hedge will be offset by the long loss on the unhedged position. None of my hedges are ever completely market neutral. Why would I do that? I can't make any money. Those are for people who are arbitrageurs, who are scalping based upon bid offer spreads or statistical stat arb. I'm not a stat arb guy. All I know is I take short positions. I got them. They're killing it right now. Everything. I just got out of a short in Interactive Brokers after $10. I covered that one and went back up. I periodically short to offset my long positions, but my short positions are never a greater delta than my long positions. So as the market goes down, I make money. And as the market goes up, I make even more money. That's how you do it. But if you're all 100% short here and that's all or none, you could play that game. But why would you want to play this game to be all short all 5 when you could just short the S&P, which captures all of them? The idea here is to take the S&P, break it into pieces like components, into a puzzle, and just say, hey, listen, the S&P is going down. Where can I get the most bang for my buck on the short side to hedge me? Oh, there it is, the XLK. Then go in and short the damn thing. Go buy puts on it. It'll offset the damage here. But for you to walk in and listen to these numbnuts on TV and get fully long here, are you out of your mind? What is your solution? If we dropped 1,000 points in the next 5 minutes, what is your solution? You don't got one. There ain't no hedge for you. You can't hedge after the damage. My house burned down. And all of a sudden the State Farm guy goes up. I'm really sympathetic to your house burning down. But look at the bright side. Now you can get enough insurance money to buy a fire alarm. What good does that do? Once you crash the car, it's done. You can't take it out of the water and fix it. It's over. It's done. Great traders manage risk early and often. And the way you do it is you get an edge. How do I get an edge? You create optics. You find means to spotting rotations of leadership. If you can do this, the world, it's like the oyster, the world is yours. That's what it is. Watch Corey, watch Brandon. They're watching all these sectors, and Corey will spit out the winners in sectors and losers. This is just a way of taking Corey's data and then flipping into a basket and sectorizing it rather than focusing on position. So rather than individual stock selection, which is what Corey does, I'm just sort of like captivating it, capturing it in a much broader spectrum. But all paths lead to Rome. What Corey does and I do are the same thing. Same thing. We're trying to get an edge and figure out what's holding the market up, what's dragging it down, and what might be that next, what might break next to bring this down. If you can do this, I don't see why you can't make a lot of money. But if you live in this like fantasy world, we're thinking that we're going to be up forever, you're out of your mind. We're going to break at some point. So if you want to know when we're going to break, I would not rely upon watching the S&P. I would not. I would rely upon watching each one of these sectors in the shortest of durations, which is 3 months, day by day by day, and see where the strength and the weakness comes from. Clearly today, the weakness is inside of beverage companies. That's where I'm short. And that offsets my long position on Lulu. Because if the market blows, Lulu's going to go back down. So what? I only own 25 shares in one account, 25 in another, and 100 in another. But I'm sitting there heavily short. I've got 2 or 3 call spreads on Coke. I'm short 200 Coke. My Coke gain is going to far outweigh my Lulu loss, even if this market breaks down 500 points. You got to be short somewhere. And I got a lot of shorts everywhere. It's just that I don't short indices. I short stocks within individual indices or ETFs. I curate very carefully, so I outperform consistently these things. You can either do the index or you can do individual stocks. But like I said, the best way to capture that big picture, that puzzle, that paradigm shift, and when the market's eventually going to break, that's the best way I know how to do it. Just from a chart standpoint, you can go into relative strength. You can't pull this off on relative strength very well. You could go into, like I showed you, you could go into, up here on Market Watch, and you can go to visualize, and you can go to heat map. That's another way to look at leadership. But honestly, This is the ticket, people. So it's a gift for me to give it to you. I kept it really simple. It takes a few minutes to like put it all together, and it's really easy to track, easy to add, easy to track, easy to understand. Take it and run with it, because this is not going to last forever up here. We're going to go down eventually. We're going to drop 5 to 10%. Gianni knows it. I know it. Corey. May not be tomorrow, but if you track this, it'll give you that edge ahead of the curve. You'll see the changes in these, which will help you identify when the S&P is about to blow. Or you can use the Arun indicator and combine both. That would help both. That would also help. On that note, I'm going to shut this mamma jamma down. I'm going to turn this over to, I think it's Brandon, and let him run with it. I'm going to do a Genesis Cog today, and I know the Genesis Cog members are extremely, I tell all of you, I make more money doing nothing than something. The key to my success is patience. I'm way more patient than any of you. I will wait forever for a trade. I waited for 5 weeks for that Coke trade. 5 weeks. But I hit it just right. You got to be right on in this market, especially when you're shorting. In the meantime, I'll let Brandon run with this and let you know, like, I don't see the market breaking today. The advanced decline is super strong. But if you pick your spots carefully, okay, there's a lot of money to be made in this market. A lot. Just make sure that you integrate value in your thinking. That's really important, because at some point, value comes into play on the way down, not on the way up. In the meantime, I'll let Brandon Chapman. Brandon, I'm having just one of those bomb days. Brandon, I told you I walked in and bought Lulu yesterday at that low 170 level. Look at LU. Right on time. Right on time. Right on time. And I've got others in play. I've got other stuff I bought yesterday that they blew out. I just stepped in and bought some Best Buy too at 67. So like I'm picking my spots carefully, really carefully.
That's great. I mean, yeah, we stepped into quantum last week, with Iron and stuff.
I like quantum.
Yeah. Well, I mean, it's just it's the ebb and flow of the market, right? Just trying to find, okay, where's those turning points? And obviously if you're buying stock, shorting stock, you don't have as much of a time frame. Options, you have a limited shelf life.
Yeah. So
you got to kind of nail the entry a little bit more closely. But yeah, but like what you said about industry groups, I used to be over the big chart. You guys, do you remember the big chart?
Yeah.
So I used to be over that. So I'd meet with MSCI and talk with GICs, what industries we should use, and vetting the calculations and stuff for it. So anyway, it's fun.
Yeah. All right. Well, I'm just going to turn this over to you. Like I said, Brent, I don't know where the top of this is. All I know is one thing: this can't last forever. This sideways movement, when it unwinds, is the most unhealthy thing I've ever seen. Ebb and flow is what makes markets work. By the way, Brandon, there's one trade I missed badly. Oracle. Do you see Oracle pop? Do you see that one? That was the layup.
You know what? Yesterday was the first time in a couple months we actually saw call flows into Oracle.
Yeah,
it's been pretty heavily steady on the downside, and all of a sudden yesterday saw calls being bought.
Yeah, anyway. I was on that stock I was like at 130. It's probably a buy. And I became what I call anal retentive, penny wise, pound foolish, which tells you even, we all make mistakes. I made a mistake on that one. I got too picky on it.
Yeah.
All right, Brandon. Have a great day. I'll see you later.
All right. Have a good one. We'll see you.
All
right. Let's get rolling here. So let me just bring up a slide deck here. We're going to talk about a few things. Talked a lot about